Ever looked at an insurance policy and your eyes glaze over? It's like a wall of text, right? It's something pretty much all of us have, but let's be honest, almost nobody understands the legal DNA behind it. Well, today, that changes. We're going to pull back the curtain and demystify the complex legal rules that make every single insurance policy tick.
So, how are we going to do this? Our guide for this journey is actually a university syllabus on the law of insurance. Now, I know what you're thinking. A syllabus? That sounds incredibly dry. But trust me, we're just going to use it to pull out the core concepts and make the ideas behind your car, health, or home insurance totally clear.
Let's kick things off with a huge question, one that really gets to the heart of it all. Is your insurance policy just a really, really complicated bet? You pay your premium, betting your house might catch fire, while the insurance company bets it won't. Sounds about right, doesn't it?
Well, not exactly. Here's the key difference. With a wager, a bet, your goal is to win. You want to walk away with more money than you started with. Insurance is the polar opposite. The goal of insurance is simply to not lose. It's a shield to protect what you already have, not a lottery ticket to get rich.
So, to really get to the bottom of this, here's our game plan. First, we'll dig into why insurance is a shield, not a gamble. Then we'll look at the 3 legal pillars of trust it's built on. After that, a quick tour of different insurance types. We'll meet the system's watchdog, and finally, we'll talk about what this all means for the contract we all end up signing.
All right, let's jump into part 1, a shield, not a gamble. This is all about getting to the true core purpose of insurance.
It all boils down to one key legal term, indemnity. An insurance contract is a contract of indemnity. That's a fancy way of saying its only job is to restore you, to put you back in the exact same financial spot you were in the moment before something bad happened. It's about making you whole again, not making you wealthier.
So if the whole point is just to get you back to where you started, what makes this system even work? Well, it's all built on 3 core legal principles. You can think of them as the 3 pillars of trust. They are the absolute foundation of the entire insurance world. The very first pillar is something called insurable interest. This basically decides who has the legal right to insure something. And the rule is actually pretty simple. You have to have a direct financial stake in it. If it gets destroyed and you lose money, you've got an insurable interest. If you don't, you can't insure it.
It's such a simple but powerful concept. You can insure your own car because if you wreck it, you're out a bunch of money. But you can't just decide to take out an insurance policy on your neighbor's car because you don't have any financial skin in that game. This one little rule is what keeps insurance from just being straight-up gambling.
Okay, pillar number 2, the link between premium and risk. The premium, that's just the price you pay for the policy, and it's not some random number. It's a carefully calculated price based on how much risk the insurance company's taking on. The higher the risk that you'll file a claim, the higher your premium's going to be. Simple as that.
And now for pillar number 3, and this one is a really big deal. It's called utmost good faith. The old Latin term for it is Uberrimae Fidei, and it means that insurance contracts demand a higher level of honesty than your average contract. Both you and the insurer have a duty to come clean and share all the important facts, even if you're not asked directly.
For instance, let's say you're trying to get fire insurance for your building. If you just happen to forget to mention that there was a small electrical fire there last year, well, that's a violation of this principle. It's not on the insurer to ask every single possible question. It's on you to be transparent. It's a foundation of complete honesty.
Okay, so we've got our 3 pillars. Now let's take a quick tour and see how these big ideas actually show up in the different kinds of insurance we see in the syllabus.
First up, marine insurance, which is one of the oldest types there is. One of the unique things here is that the policy can actually be assigned to someone else. So if a big shipment of goods on a container ship gets sold to a new owner while it's still at sea, the insurance policy protecting those goods can be transferred right over to the new owner.
Next, fire insurance. This one introduces a really cool concept called subrogation. Imagine your house is damaged because of a faulty washing machine. Your insurance company pays to fix the damage. Subrogation then gives them the right to step into your shoes and go sue the washing machine company to get that money back. It's a smart rule that makes sure nobody gets to profit from a disaster.
Now, life insurance is a little different from the others. In legal terms, it's often called a contract of assurance, not insurance. Why? Because the main event it covers, death, is 100% certain to happen. The only unknown variable is when. So it's not a question of if the policy will pay out, just when.
And finally, we've got accident and health insurance. And this one brings us right back to that first big idea, indemnity.
This insurance isn't about making a profit when you get hurt. It's about covering the hospital bills and the income you lost, all to get you back to the financial place you were before you got sick.
So you have this massive global system built on these principles of trust and risk. But who's watching the watchers? Who makes sure everybody is playing by the rules? That brings us to our next section, the systems watchdog. The syllabus uses this phrase, social control. All that really means is that insurance is just too important to society to be left to its own devices. It serves a public good, so there has to be some kind of oversight to make sure companies are stable, that they treat people fairly, and that they're really helping society. This is where regulators step in. And the main watchdog mentioned in our source is the Insurance Regulatory and Development Authority, or IRDA. And this group has real teeth. It gets to write the rules of the game. It has specific powers to protect you, the policyholder. It keeps an eye on how rates are set, and it's also responsible for making sure the whole industry stays healthy and stable.
Which brings us to our final section. We've gone through the big ideas, the different types, the regulators. So what's the bottom line here? What does all this mean for you and that contract we all sign? Here's the big takeaway. Next time you look at your insurance policy, remember it is so much more than just a product. It's a legal promise, and it's a promise that's standing on a foundation of principles that are centuries old. Ideas like insurable interest, utmost good faith, and indemnity. It's a whole legal framework built on trust, risk, and responsibility.
And that leaves us with a final thought to chew on. These principles were dreamed up in a world of wooden ships and house fires. But our world is now facing totally new kinds of risks, right? Things like massive cyber attacks or the wild unpredictability of climate change. So the question is, how will these old laws adapt? What's going to be the next chapter in the law of insurance?